Apple just dropped a bombshell, but that's not all. The real nightmare is just around the corner. Stay tuned. I'm your host, Steve Metre, and thanks for joining me today. In our show today, Apple just dropped a bombshell that will change the face of the tech industry, but the real danger is yet to come. I'll show you why the economic nightmare is about to unfold. Plus, amid today's market struggles, our momentum trading strategy is a bright spot as our subscribers are seeing huge returns. Stay tuned to the end of the show to see how you too can profit big on momentum swings. Now let's head over to Bloomberg, where he picked today's story up as Apple will add 20,000 U.S. jobs amid threat from Trump tariffs. And on the headline, this appears to be exactly what President Trump wants. He wants companies to take action on the tariffs and start creating more jobs here at home. The question is Apple going to actually go through with this? I'm going to make the case of why they won't, but let me get your feedback. Let's hit the comments, because the company said Monday it plans to spend $500 billion domestically over the next 4 years, which will include work on a new server manufacturing facility in Houston, a supplier academy in Michigan, and additional spending with its existing suppliers in the country. He's investing hundreds of billions of dollars, Trump said, but here's the real issue. He implied that the iPhone maker is investing locally because it does not want to pay tariffs, and Trump has threatened an additional 10% tax on items imported from China, where Apple builds the vast majority of iPhones and other products. So here's what we're seeing, some concession, at least from Apple's side, hey, we're going to create some jobs here, we're going to spend some money domestically, but don't tax our iPhones and other products. Now, the question I have for you, and I want to get your feedback, does Apple go through with this, or is this just an excuse to get out of the tariffs? Are they paying lip service to the Trump administration? Because here's what I think could happen. In 4 years, we know Trump won't be in office, but here's the other factor. If the economy turns down, Apple has a reason not to go through with it, because a $500 billion investment in 20,000 new jobs over the next 4 years will mark Apple's biggest commitment to date. And Apple said it hired 20,000 research and development workers over the last 5 years. Instead of 2021, it would invest $400 billion locally over the next half decade. Again, the question is, with the U.S. economy slowing, do they go through with it? Love to know from you. Hit the comments below, because the real nightmare, as you're about to see, is starting to unfold all across the country. Let's head over to Texas, because again, if what's happening in Texas spreads across the country, well, there's a good chance Apple may not deliver, as Texas manufacturing activity falters amid increased uncertainty. As Texas factory activity fell in February after rising notably in January. And what did we see after the election? We saw this huge surge in activity in the manufacturing sector, and this stemmed from the fact that executives said that consumers were going to come out and spend big after the election, that it was completely due to election uncertainty that people were keeping their money in their wallets. And so what happened all of a sudden is everyone acted on that. They said, we got the president we wanted, now the economy is going to boom. And then what happened? Here we are in February, and we're seeing the Texas manufacturing survey turn down. We're seeing it turn down in New York. We're seeing it slow down in Philadelphia. And all of a sudden, all this excitement, this euphoria is finally catching up to the real economy, because other measures of manufacturing activity also declined this month. New orders index fell 11 points to -3.5. The capacity utilization index slid 14 points to -7. The shipments index remained positive, but it edged down too. So again, we make the case that Apple's looking to get out of tariffs, and it makes perfect sense, but the U.S. economy is slowing down. And what that means, is you're about to see, is the demand for products, including Apple's, is about to go down as well. So does that mean they go through with this big spending plan and hire all these people? Or again, do they use the economy as a scapegoat to get out of it? I want to know from you. Weigh in the comments, because one thing that should be rising, that is your trading account. I want to show you, we went into the weekend with 91% win rate on our CTA Time Pro. This is how we trade against the machines, and clearly you can see we win. But for our momentum traders, look at this. We walked into Monday's trading with a 92% win rate. You want to know how you can beat the machines or trade momentum to make big profits? Stay tuned to the end of the show, or grab those links in the description below. Be sure to use those coupon codes for a free 30-day free trial, because when we look at what's happening in Texas, it's all about oil. And one thing we know about oil is when demand for the economy goes down, oil prices fall. And for Texas, this is a huge problem. As we look at current new orders, this is the diffusion index for Texas against crude oil prices. That's West Texas Intermediate. That's shown in red. And here's what you can see coming out of the election. There was a surge higher in new orders, but look what happened to crude oil. Prices really didn't go up because the economic fundamentals do not change based on who's on office. Now, it does change over time, but it doesn't have an immediate impact. And after all the euphoria sent the index index higher, reality is now starting to set in as new orders come down, and that isn't right in line with the reality of what the oil industry is telling us, because if prices aren't going up, then demand and new orders for Texas isn't going up as well. But there's an issue here because they said capacity utilization fell. This is a big problem because when you look at the broad economy, you want to see capacity rising in the manufacturing sector, because not only does it tell you that inflation is going to rise, it tells you that demand is increasing. Well, when demand goes down, well, there's another factor that comes into play, and that's a demand for labor, which is why we're putting a big question mark on Apple's statement here. And let's take a look at capacity utilization in blue against the unemployment rate. That's the U3 in red. And what do we see? Going back to the late 1980s, capacity utilization came down. It didn't have an immediate impact on the labor market, but there was an inflection point as we went into 1991. We see capacity utilization fell, and next thing you know, the labor market came unwound right into that recession. Let's move forward into the mid-1990s. What do we see around 1997? A peak in capacity utilization. It starts to decelerate, but again, there's enough jobs being created in the economy that it doesn't impact the labor market. Well, that is until early 2000s when all of a sudden you see capacity utilization drop as demand falls out, and well, the labor market comes unwound as well. You see the same effects right around 2008 as capacity utilization plunges, sends manufacturer workers to the unemployment line, and that takes a lot of other people with it. And today, what do we see? A similar setup, despite the fact that political elites are telling us that U.S. labor is strong and robust, but capacity utilization trending down, telling us the unemployment rate likely to head higher. But perceptions of broader business conditions worsened in February, so they noted things are getting worse as the general business activity tumbled 22 points to minus 8.3, and company outlook index fell 24 points to 5.2. So you're seeing again all this optimism start to go away, which again makes me question Apple's motives here. Is it simply a move to get out of the tariffs, or are they actually going to follow through with this? Again, weigh in the comments below, because labor market measures suggested flat headcounts and shorter work weeks this month. So what we saw in Texas as demand went down, and this is exactly what we said would happen, that we would see eventually it would impact the labor market. And the first way it does it is by cutting hours. So we see that happening. Let's take a look, because the employment index came in near zero, with 12% of firms noting net hiring and an equal share noting net layoffs. The hours worked index slipped minus 14.2, the lowest reading since mid-2020. So here's exactly what happens. Business slows down, demand goes down, and hours are the first thing to go. And now let's take a look at average weekly hours of production and non-supervisory employees against the unemployment rate. So we talk about this nightmare scenario that's coming, and this argument that perhaps Apple is simply playing lip service to the administration by saying, look, we're going to create a bunch of jobs, we're going to build some factories here, just don't tariff our goods because we need to maintain our massive profit margins. The risk is, what if they don't go through with it? Does that mean Trump comes in and puts tariffs on Apple products? Well, we'll see, because let's talk about this nightmare scenario. As workers see their hours getting cut, what happens is some places start to lay off, and then next thing you know, there's an inflection point where those hours worked translates into job losses. Again, you go right into that 90s recession. Look at going into the dot-com bubble. A lot of people say they didn't see it, but the labor market was very clear. You see average weekly hours going down, and next thing you know, it's going down so much that companies are laying people off to protect the hours of the people they want to keep. You see the same thing happen going to the global financial crisis. Hours worked are steady. Well, that is until they're not. They went plunging down. The labor market unwound. And how about where we're at now? Again, the political elites tell us the labor market is strong and robust. Apple says we're going to hire 20,000 people. But what do you see in average weekly hours? A massive downtrend here, which suggests that people aren't going to be able to afford Apple products or a lot of other things. And that's the risk here, because we continue to see inflation rising. And what we're seeing in hours worked is those that do have jobs, they're going to take home less. And so we know that with rent prices, energy prices, and food prices still rising, it's going to leave less money on the discretionary side of the budget. I think it's going to have a massive impact on Apple's demand. And input cost pressures intensified in February, while wage pressures retreated slightly. Raw material prices index pushed up 18 points, and finished good prices inched up 7.8, meaning input prices into the factory are rising, and so too are output prices. We've been hearing this, that manufacturers and service providers are going to pass on higher prices. They're not taking it at the margin anymore, And this is a very clear sign that we're entering a stagflationary environment, because as long as hours worked are on a decline, it doesn't matter if people have jobs because they're taking home less, and against higher prices, you go right into a stagflationary recession. And there's some interesting notes here as we look to some of the responses in the Texas survey, as sales volumes have been trending downward in the last 28 months. We've cut hours to 36 per week, and it's not enough to get profitable. Next week, we're cutting further to 32 hours, and we're laying off 3 people. So you can see the trend is going to be less hours. Less hours means less pay, less money spent on the discretionary side of the economy, pointing the U.S. economy now right into a recession, which makes me again question Apple's motive here, which I think, at least it's my opinion, love to know yours, is simply to get out of those tariffs. And here you can see the evidence that we're heading right into stagflation. As we look again at average weekly hours of production of non-supervisory employees in blue against the consumer price index in red, that's shown on a year-over-year rate of change. And here you can see back in the late 80s, prices were rising. And yes, we've talked about how wage growth held up, but look at hours worked. They were in a significant decline, meaning workers could not afford those higher prices. You go right into a recession. Same thing happens going into the dot-com bubble. Inflation's taking off, and while everyone is excited about all the tech euphoria, hours worked were getting slashed. Workers could not keep up with inflation, right into the bubble. Let's move forward to the global financial crisis, because prices surged, but what happened? Hours worked didn't. Take-home pay shrank relative to prices, right into the global financial crisis. And what do we have now? Hours worked going down and looking to be right into a recessionary territory, as we see manufacturers and service providers likely pushing higher prices onto consumers at a time we know they cannot afford them. Question is, will Apple be passing on higher prices too? We'll find out soon enough, but that's not the only issue. We look at Texas, we're seeing layoffs starting to begin, hours work getting cut. Let's turn to Starbucks. We talk about this nightmare. You can see it's coming as Starbucks cuts 1,100 corporate jobs to speed up turnaround, and they were going to cut jobs, but now they've accelerated, as it represents about 7% of the global employee base working outside of the company-owned stores. This is massive, and the CEO, who took over in September amid declining sales at the coffee giant, announced their impending restructuring in January. So again, we've talked about this. As sales go down, you see from some of those responses from the Texas survey, it says, look, we're not profitable here, so we've got to cut hours, and then we're going to start cutting jobs. You see the same thing as Starbucks. We want to defend our margin, so we have to cut employees. The question is, will Apple be able to defend its margins if demand goes down? Will they be hiring all these people? Well, I'm not so sure about that. But how about Domino's as U.S. sales fall short, showing worsening conditions? Again, demand going down all across the country as Domino's sales rose less than expected in the fourth quarter, highlighting the mounting challenge to appeal to cash-strapped Americans. Remember, it wasn't long ago that people were baffled why the economy wasn't booming, and now what are you seeing from the media? They're starting to wake up and realize that people cannot afford higher prices and may not even be able to afford a pizza from Domino's. And believe me, Domino's tried to get people to buy. As a result, show the difficulties restaurants face to entice budget-conscious diners. Domino's tried everything from a twist on buy one, get one offer to a partnership from Netflix. Clearly, neither really worked, and they're unlikely to work going forward, because what have we seen? A continued decline in hours. That means, again, take-home pay shrinking, less money spent on pizza and Starbucks. But Microsoft also dropped a bombshell, as some AI data center leases are now being dropped. And this is huge, because while we have yet to get to the level of color via our channel checks that we'd like into why this is occurring, our initial reaction is that tied to Microsoft potentially being in an oversupply position. You know, you talk about the AI bubble, a lot of people think that the Magnificent Seven are continue to go higher and higher. The reality is what we're seeing is a lack of demand all across the board. This isn't from low-end consumers not being able to afford pizza and coffee. This is about businesses looking at AI and saying, you know what, it's not delivering, it's not doing the things we need it to do. And for Microsoft, that's a big hit. And if that spreads across a lot of other tech companies like Apple, you can start to make the case of why Apple isn't going to hire all these people and build all these factories. Perhaps it's all being done just to make sure that the tariffs are not applied to their goods, because we're seeing more evidence now across the services economy as store closures outpace openings amid historic shift. For the first time in recent years, retail store closures are exceeding openings, and JL tracked over 9,900 announced closures closures from 2024 through mid-February against just 7,700 openings. That means net job losses. The discount, dollar, drugstore, and apparel sectors are seeing the largest number of closings. And bankruptcies have driven a clear acceleration of closure announcements as companies are going broke. In recent months, distressed retailers have indicated that they will close part or all of their brick and mortar portfolios. Nearly 700 Party City store leases went up for auction, while earlier this month, Joanne said it will close over 500 stores. And again, these are jobs, my friends, that aren't coming back. So we come back to Apple, who said, look, don't tariff us. We're going to create a lot of jobs and put in some infrastructure and build factories. The reality is of what we're seeing is the economy slowing, and with paychecks shrinking due to hours worked declining, the reality is many Americans who have been buying Apple products most likely will not be able to continue that spend. The question is, will Apple use the economy to get out as a free way to say, hey, you know what? We were going to do all these things, but all of a sudden the economy went down. We're not going to follow through. That is the question I want to know from you. I don't think they're going to deliver, but something that is delivering is big returns for our subscribers. As of the close of Friday, our Brazil trade still up a massive 8.02%. That trade went on the books on the 16th, and these are the notes right from our reports. We told our subscribers, buy this at open. Here's the reason why. Here's your stop loss levels, and take this trade. And you look at the success our subscribers are having. Our CTA Time Pro subscribers are sitting on a 91% win rate. Our Momentum Time Pro, they're sitting on 92% win rate. This as of Friday. And how do we know about that Brazil trade? Well, a lot of people trade momentum. They look at these oversold conditions and they say, well, that's when I got to buy. And what happens is they're buying and then it goes down, and then they buy and then it goes down, and they buy again and they give up. What they don't realize is momentum also needs one additional factor, and that is trend. So we run a proprietary overlay that tells us when momentum is coming out of oversold territory and the trend is rising. Told our subscribers to buy right here, and now is sending them up into big profits. Every day you get the report, but here's the best part. You don't have to read it. In addition to getting the report and all the tradable signals, I go through the trades and tell you these are the best ones. We back tested our reports. We give you risk control levels. We give you a full weekly update. I disclose even how I'm trading my own reports. Here's the best part. You get that 30-day free trial. Grab those links in the description below. Start trading, start making money. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.